Hi, my name's David Linton, and I'm pleased to announce that we've put the price targets now on the very popular TradingView platform. And for this next hour or so, I want to take you through how to use these targets on TradingView. It's pretty groundbreaking, and this is ideal for people who are trying the targets and want to know how they work, or if you're just curious to understand. So in this presentation, I'm going to talk to you about where these price targets came from, understanding the idea of time horizon, using key price levels with the targets and midpoint averages. And then most of this presentation is going to be about how to use the targets. And you can download this presentation and these slides. There's 100 slides here at this address, updater.co.uk/TV for TradingView. So you can download this presentation and the slides and a trial on TradingView at that address. So before I start, I must just make a disclaimer. This is educational. It's designed to help you develop your skills and strategies. And these price targets are derived from a decades-old technical analysis technique. And the targets are approximate. So I just start with this disclaimer. I'm not promising, roads to riches, and many of the examples here, the charts will be out of date potentially by the time you're looking at this presentation. But it should give you a very good understanding of how to use these targets to assist in you making trading decisions. I started out doing technical analysis in the 1980s. I traded on the London traded options market. I founded a technical analysis software company called Updater in the 1990s, still going, and I've got qualifications. I've done the exams, the certified financial technician exam, and most of all the coveted MFTA, the Masters in Financial Technical Analysts. I run training courses, and I've written a book on Ichimoku charts, cloud charts, and I teach that module for the Society of Technical Analysts, and I'm a regular market commentator and speak at lots of conferences. We announced the targets at the International Federation of Technical Analysts conference in 2023, and they were launched on Updater Analytics. And I've worked with Trevor Neal at Beta Group, and we offer corporate technical analysis training. And I do the monthly technical analysis surgeries for LSEG, London Stock Exchange Group, on the LSEG Workspace product, which is in fact TradingView charts. So I've got over 33,000 followers on LinkedIn. And of course, as I say, I give trading courses, and I'm a member of most of the societies, the American Association of Technical Analysts, Professional Technical Analysts, the International Federation of Technical Analysts, where I'm an ambassador for IFTA, and the CMT Association. Of course, I teach at the STA in London. I actually speak at conferences, as I mentioned. I'm speaking at the annual IFTA conference in Germany at the end of September, and the CMT Global Summit in Dubai at the beginning of October. And I will be talking about the price targets more at those conferences, but this is a good overview for anyone who wants to try and use these and targets and get the most from them. So they are basically on the Updater platform, on Bloomberg. They were launched on Bloomberg earlier this year in 2025. They've been very popular on the Bloomberg terminal, and now they're on TradingView. And the targets have been peer reviewed in the International Federation of Technical Analysts Journal. The address for that is here. If you go to the IFTA website, you can download this and read that paper. But today I'm going to focus on them on TradingView. And of course, the really big advantage of them being on TradingView is that you can have them on web, on the TradingView app, on Mac, on iPad, on iPhone, on your phone, and it's great to see these targets on the phone like that. And basically, I'm running the TradingView app here, and I can also run it, of course, in a website. And just as an aside, this is them in Updater, which is the application that I use. So basically, the targets are in lots of places now, but for those of you using TradingView, this is the ideal place now to use these targets, and I want to explain how you can get the most from them. So basically, it's a technical analysis technique that was really invented in the 1940s, but it's been reimagined, and it comes from the point and figure technique. Now, anyone who has been doing technical analysis for a very long time will know all about the technique. Abe Cohen, in his book in 1947, this is the book, I've got this book. In his book in 1947, he basically came up with this projection method, which was the height of the column on a vertical column would produce the target. And before the age of computers, people did these charts by hand, and they basically, it was a way of recording the market information. And they go back to the days of the ticker tape, when people were using this as a technique for recording price information when it was just too hard to record all the prices. And if you imagine the ticker tape was whizzing out, I took this photo at the New York Stock Exchange. I was there at a conference a couple of years ago, and this is what they would do, and they would jump across to the next column, and this is the point and figure technique. And it became a noise filter and a necessary shorthand in the markets. And Cohen came up with this idea of point and figure signals, double top buys and double top sells, and this is really the essence of where these targets come from. If you want to understand point and figure charts, the book is The Definitive Guide to Point and Figure by Jeremy Duplessis. This book, I helped edit this book. I worked with Jeremy for 15 years at Updata, perfecting point and figure charts, and it's a really brilliant book if you want to understand point and figure. This is where the targets are derived from. So this vertical count method is really the essence of the price targets. This is what a point and figure chart looks like with all the price targets drawn on, but the problem is most people struggle to understand a point and figure chart. Very few systems actually can computerize it properly. It's very hard to computerize and construct properly. Updata is really probably the only system that does. And so consequently, people just struggle with point and figure charts. And the internet changed everything. Every price and every trade could be recorded. There was no need for this method anymore, no need for the shorthand. And that's really why, in a way, point and figure charts have been superseded. But it's a bit of a shame, because with that we've lost the real value of the targets. So the proper charts are not easy to get now. They're not easy for a newcomer to learn. They're considered old-fashioned. The shorthand is no longer needed. There is no time in a point and figure chart. The axis is reversals, the x-axis. So a lot of people find this really difficult. And that means that the price targets don't have a time frame. You couldn't project them forward, which is what these price targets we're attempting to solve. And most of all, this is something that's come to light really in the 2 years, is that you have no idea when a price target is failing with time. Now, there's nothing wrong with the method. It's just deemed to have been largely superseded. So what we did was we took these price targets that you would get on a point and figure chart and put them onto time-based charts, so that we could actually imagine where the price is going by looking at a candlestick chart or a typical time-based chart. You could start to use these targets to get a feel for where these targets are actually pointing to on a chart that you're actually likely to use, rather than flipping to a chart that you're not familiar with. So first of all, just a couple of key technical analysis points. The first one is time horizon. If you've done any of my LSEG sessions, or you've done training with me before, or you've read my Cloud Charts book, you'll know that this is a very key point, that when we're looking at daily charts, we're thinking weeks ahead. We're looking at weekly charts, we're thinking months ahead, and we're looking at hourly charts, we're thinking days ahead. So it's important to remember this idea of time horizon. And today, mostly I'm going to be looking at daily charts, but you can go down to shorter term charts. And it's important when we think about this that we think also about key price levels. levels of resistance and support. So one of the indicators that we include with the targets is a support and resistance indicator that we've developed as one of the tools on TradingView that goes with the targets, which will identify significant highs and lows. And this is done as a simple formula where we basically look a few bars either side of an extreme point to decide. And the default is set as 3, but you can actually change this. So it draws those levels on a chart. This is really important when we start to look at targets. We want to see price targets and critical levels lining up. And so these levels are really, I think, a part of using the targets. The settings are very straightforward. The default is set as 3 bars before and 3 bars afterward. You could change it to 4 or 5 or 1 or 2, whichever you want, but 3 is what I use. And you can configure to show more of these lines. I just look at the last 2. And if it breaks, it just turns purple. So we know that a significant level has just broken. So that's quite key. So the settings are there in TradingView, very straightforward. Trend definition is another big factor in using targets because we want to favor targets with the trend. Now, anyone who follows me, I often use Ichimoku charts for the trend definition, but and Ichimoku charts are based on midpoint averages, and so we supply also with the targets a midpoint average. I like the 21 bars to 21-day midpoint average. If I'm above that line, I know I'm above the middle of the 21-day trading range. If I'm below that line, I know I'm below the middle of the 21-day trading range. So here you can see we get a target. We're below that range all of a sudden in the lower half, so that gives that target more credence. We cross above, we give an upside target, so we can add more value to the upside target based on the trend. So it is important to take trend into account as well. The settings here are also very straightforward, just to color the line width and what period you want to use. So I do urge you to use certainly the levels and the trends with the targets. Now, if you're on a free version of TradingView, you'll only be allowed 2 indicators. So in that case, you've got to probably just use the targets and the levels or swap. But if you're on a higher version, you can have multiple indicators. So let's talk about the price targets. This is the main aspect of using these. We think about time frame, support and resistance, and trend state. We want to take all of those things into account. So remembering this is part of the point and figure technique. That's where it's come from. So just thinking initially about what a point and figure chart does and translating that to a line chart. So this is the traditional point and figure 3-box chart, and that's what it typically would look like as the setup, if you like, on a line chart. So we have to pull back by 3 units, and then we need to break higher by a full further 1 unit. So you need a pullback of at least 3 units and a break higher of 1 unit. And this thrust off a low or a breakout needs to not pull back by more than 3 units. So this is what we call an uninterrupted buying thrust. That's the first move, then a pullback, and then a move by at least 1 unit higher. And on the downside, it's the reverse. So it's a rules-based system. So targets are about thrust. And then when I'm doing the training, I normally hold a cricket ball and I say, if you imagine that you're on the outfield of a cricket pitch or a baseball pitch, you want to get that ball all the way back to the keeper, then you've got to pull your arm all the way back. So the bigger this initial move, this uninterrupted buying thrust, then the pullback, and then the activation, the break, the bigger that initial move, the bigger the resultant move. So that wave of buying leads to this overall potential. That's what drives these price targets. The target structure is literally that. I like to add in the trend, and you want to look at where the key levels are. But here, once we break 1 unit higher than that level, so it's more than just a small break, a significant break. Once we break it up that level, the bulls in this buying are confirmed, and then we start to see the second wave of buying come in. So the target principle is really very simple. On your trading view, when you see these buying thrusts, those buying thrusts are leading to these price targets. So these buying thrusts, and then through the activation levels, so they're drawn as twin lines there, those are the thrust targets to these target prices. That's where these come from. So it's just an old technique reimagined onto your charts. So now I want to just explain to you, understanding the idea of target size, unit size, the variables for price projection, and the methods we can use to project into the future, and how we can increase the accuracy of these and just the recommended settings. So understanding the target settings, this target is a green target that was given. We've got them color coded as green up, red down, orange is where they haven't yet been activated. So it's a traffic light system. If we break through that activation level, it will turn red. And equally, if we've got an orange target to the upside and it breaks higher, it will turn green. So this target was given back here on Coca-Cola. This was back in June last year. It was activated. We didn't quite get to the target, which we know as slightly bearish confirmation. And at this point, when you get the new target, you start to say, well, maybe that target was nearly done. So you do need to take note of what is happening with the price movement, and we'll spend more time on that. The notation is the way it's set up in your system is that the bold ones are the ones that are not yet reached. The less bold ones are the ones that have been met and also activated. The ones that are yet to be activated are thin. So the bold ones are the ones that are activated but not yet met. So we can just imagine this. This is the setup that generates this target. So here the target is achieved. If you don't quite get there and you start to be wandering sideways or falling away, then the target is exhausting. Whilst we're in this zone, the target is in train, and then the target is activated. Of course, we move about. But if we move back below the activation level, it's a little bit of a warning that the target is deactivating. We move back below this low, making a lower low than the pullback level, then the target is failing. And if we pull back below this level, then the target is completely negated. And we'll talk about that in a minute. But that means that all these bulls that drove that initial buying thrust have left. And so the target is negated. The same applies to the downside in reverse. So we have downside targets and the target is negated. So it's just the same in reverse. So the target settings on TradingView on this little bolt or nut, and so in TradingView you just literally hover here and you'll get this great big long dialogue, and in TradingView, this is programmed in their PineScript language. We don't have any option to make this any different than this. It's just a list of settings, but we'll talk you through those settings. But that's where you hover over to change any of the settings that we're going to look at. So here's a target that's active. It's a target in train. Here's a target that's not yet activated. It will turn green when it is activated, when we move above that level. And this target is active, but it is now less valid because these targets are taking over. So just that's a way to think about it. Targets are negated. They turn gray on your system. So this target is negated because we've moved above the level where that thrust was initially generated. So that is a negated target. It was activated, but it was negated after it was activated. Now we nearly got there, but it is since it's gone because you've moved above that level. So it's turned from red to gray. Now you can, in the dialog, you can choose to show. I just show achieved and activated targets, but not and unactivated targets. That's what I look to show. So that's quite key. If we look down to the next level, target negation before activation. So this is where a target is given here. In this instance, we've got one that is grey, but the target was negated before it was activated. So it moved back to that level there, it negated that target, so it was never activated. And they are more common, which is why you should always wait for targets to be activated. Now you can change all these targets as you wish, but the color coding is up to you, but these are the defaults and this is how they come. So let's talk about unit size. So this is, anyone who understands point and figure, this is what we used to call box size, and this is where thinking about time horizon becomes really important, because if we change the unit size to a smaller unit size, we increase the sensitivity of the chart. So if you imagine you're using a unit of $1 on a $100 stock, say, and then you change it to half a dollar, well, you needed to pull back $3 on a dollar. Now you only need to pull back $1.50, and the chance of an uninterrupted thrust is less because you only need to pull back 1.5. And to activate it, you only need to go up half a unit, not whole $1, so 50 cents. So bearing that unit size does make a difference, and we need to think that different products have different price points. So if you think of something like the euro, the rule of thumb is you would normally use 1% of the price. So if you think of something like the euro, we'd use 1 cent. If you're using the NASDAQ, where you've got 22,000, you'd use 250 points. So you can see that changing those unit sizes is really quite key. Now, this is what we call an arithmetic, and the rule of thumb is we start with a sensible unit size near 1% of the price. And so that's, but it's all pre-configured for you, and I'll explain the configuration settings to you, but this just shows you the difference between what you can do. So then we think about unit size variation, not across instruments, but on the same instrument. So here we see on the NASDAQ, a unit size of 250 points means that we need to pull back by 750 points, and we need to break higher by 250 points. Here, it's only 100 points, and now we're getting different targets. Notice that we've got these little targets creeping in that weren't showing on this chart because you didn't get that setup under the less sensitive setting of a smaller unit size. And so this target is actually, this target was generated back here. This is a new target that's given on the 100 chart that you're not seeing on the 250. So unit size is really quite key. I like to use log scale, and that is where the box size or the unit size is varying. So if you imagine as we go up, the unit size is getting bigger and bigger and bigger. And then so these are true log scale units. We're using a log of the price, and that just means that we're using like with like. So if I set my settings to 0.5%, whether I'm using it on Eurodollar or on NASDAQ, I'm still using the same box size. So log scale has that advantage. And if you're going through lots of different charts, that just means you're not having to think about the unit size. You can use closing prices for the thrust and the pullback, or you can use high-low. So if you imagine the intraday or intra-hour or intra-week high-lows will give you activation and pullback that you would not necessarily see on this chart. So you can see here that this target has been activated because we've pulled through, whereas on this chart, it's actually it hasn't been activated yet because we're using the close. We haven't had a close above that level. So you will see slight differences. I use the close. I like to see the price closing through there. So this idea of time horizon now starts to have meaning in terms of percentage size that you use. So I use 0.5% on daily charts, 1% on weekly charts, and 0.1% on hourly charts. Now you can configure those settings, but that's what I use. So this is a daily chart of US 10-year yields. You see we have upside targets and downside targets, a mixed picture. We'll talk about how you resolve that when you've got conflicting targets later, but you can see that you've got 0.5% is a unit size, and it tells you down here what the unit size is as well. So that's a medium-term view, and what it says is there's uncertainty about yields. We've got downside targets and upside targets. When I go from that chart to an hourly chart, it changes. In this case, I'm using 0.05, and it changes, and it now is giving me downside targets only. So it's telling me that in the medium term, it's uncertain. In the shorter term, I have got downside targets. So that just gives you a little bit of a heads up by going down to the shorter term time frame. And if I go to the longer term time frame, you can see here that we've come up into the pattern where here these longer term targets are a little bit more dominant. So we've got this interesting scenario where medium term is uncertain, short term is a bit bearish, and the longer term is a bit bullish for the price. So we've just got a lot going on there, but that's why the importance of moving through the different time frames to understand what's going on. So how far will we go in price? So we've got the pullback, we activate, how high will we go? Now, the traditional three-box method in point and figure assumed that the first move was a third, and then the resultant move was 2/3 of the overall. And so that first third, it comes from the three-box construction. In this instance, in these targets, you can actually alter the factor. So just using a factor of 1, so this argues that a move into a consolidation phase, and a move out of a consolidation phase will be approximate. So that's one way of looking at it. Target factor that you could use would be Fibonacci, so you can change your target factor to 1.618, and in TradingView, in the settings, you'll see here target price factor. That's where you can amend that factor. And then the classic point and figure one is 2. That's what we're set to. And if you're using log scale, it will use 2 log, which means the targets will be more exaggerated to the upside and less exaggerated with the smaller box sizes to the downside. So that's a factor is worth thinking about. You can adjust the pullback as well. I don't recommend you do that if you're a newcomer, but the bigger the pullback, you can see you can have a 3-box reversal, which is the recommended setting. You can use 2 or you can use 4, and your targets will all be different. So you quite often find that 2 produces more targets and 5 produces too few, and they're too exaggerated. 3 is the sweet spot. So should you use arithmetic or log scale price units for the targets? And this is a really key point. And the reality is, if you're trading a particular instrument and you trade that one thing intimately, you probably want to get used to using an arithmetic box size, especially for the shorter term charts, because these round levels, which you will not get on the log scale, these round levels become important to traders. So they're using an arithmetic size like a 10-cent chart will be quite important. This is a 15-minute chart of crude, and you can see these levels are pointing to round numbers. If it was log scale, these numbers wouldn't be round. So that is a reason for using those charts, and you can vary the unit size. So here's the 5-cent, 61.05, 61.50, and here you've got different levels, and looking at those levels lining up on different time frame charts is what we call a cluster, which we'll talk about. If you're looking at lots of charts like I do, I mean, I'm looking at hundreds of charts a day, then just having the convenience of a log scale setting that does it all for you, you're just comparing like with like. So no matter what the price of each instrument is, it's going to use 0.5% log scale. So I can just go to my charts, and in TradingView, let's choose a list. I'll just go to the Dow 30. And now you see the power of just using the 0.5% on each chart. We literally go through the list, and it will just do and work out all the targets for you. So it will put the targets on that 0.5% basis. So it's a really good way of just running through the charts and quickly putting the targets on. So from that point of view, the ability to just go through lots of charts quickly with those units set and I do recommend 0.5% is the ideal size for daily. So the key thing about targets is that they are approximate. Not all targets are achieved. Targets and the state of a target being achieved or not achieved is a form of bullish or bearish confirmation. The targets pointing to key price levels of resistance and support increases their likelihood. Multiple targets pointing to the same price area. I showed you on different charts how you're getting to the same area on that oil chart, or if you're getting different targets on the same chart pointing to an area, that's what we call clustering, and it increases the likelihood as well. The nearest targets must be met first. Beware of improbable ones. Targets not reached or exceeded. That indicates bullish and bearishness. So that's what I talked about. The achievement of targets is quite key. You can have opposing targets, and we favor the ones with the trend, but do understand this idea of negation and activation. There's quite a lot to it, and there's really more to teach than in just an hour. So the big one in developing these targets over many years has been deciding how long it would take to get to a target. And probably the longer it will take, the greater the upside. So the bigger the target, the longer it's likely to take is just a general rule. But remember that the first rule of point and figure targets is that they do have no time scale. So what we're attempting to do here is to try and put a time scale on it. Now we do this over many years. We researched 5 key methods of doing this, and I'm going to talk through these 5 methods. But the first one, which is the price time ratio method, is the simplest and it's the preferred method. You have an initial thrust, you have that generates how high we're going to go in the upside. In the case of an upside target, how long will it take? That's about method. So this is target factor, and this is about target method that we're going to use. So this is the method, and you'll find this here in the drop down menu in your trading view. So here I'm using the time price method. It's written here. If you just go and hover there, go to settings, you can see these are the 5 different methods. But I do recommend, if you're starting out, just to stick to time price ratio. But let's just go through these so you can understand. So the first one is the time price ratio. And so this is really simple. It's just default is 2, 2. So we found that tends to work pretty well on most daily charts, 2, 2. Now, what this says is that we go 2 units, so it's a 0.5%. So we go 1% every 2 days. It's a unit, 2 units every 2 days. So we go 1% every 2 days. We look at that here. The units are shown in this legend here. We look at that. Has it been right? And we can actually adjust that, and we can say, well, actually, it's nearer. Maybe it's nearer 3. I've got 3 targets, so that's pretty powerful. I can go back to here, and I can go and say, okay, let's look at what happens if I change this to 3. So you'll see now that the target's shifted, and now it's saying that it's got to go. It's going 0.5%. It's going 1.5% every 3 days. So you can see now that's fitting a little bit better. And I personally don't feel I need to really adjust these too much, because I can see if it's not quite meeting the 2, okay, this instance is 3, but I just use the 2, and then just ideally I can see whether we're running to target or not. But these are targets very much in train, and you can see that by adjusting them, we've probably got a nearer likelihood of where they would be met. So you can see there is 2, there it is as 3, and it just extends them out. So it's saying sometime between the beginning of September and the end of November, that's the percentage upside potential, based on these buying thrusts that we've seen in previous waves of uninterrupted buying. Thrust angle is where we actually work on the basis that the faster the thrust, the quicker we'll get to target. So it's just an assumption, and you can now see that these targets are not parallel. They were parallel in the other example because we're using the same ratio on all targets. Now we're using a half slope of the angle. And so what we're saying is on this one, it took quite a time for that thrust to develop, so it's going to take time for the target to be met. It's hypothetical, but that's the basis. Here we've got one that would happen very, very quickly, so it's just literally straight up. And so this is another method. We could say, well, the speed of the thrust gives me the speed of the target. Another method, the third method, is the time to activation. And so what we're saying here is, okay, I've had this initial buying thrust, and then it's taken time for that to be activated. And the longer it's taken to be activated, then the longer it's going to take to get to the target. This is not a quick breakout, if you like, of the level. So that is another method. And you can see here, this one was activated very, very quickly. So the speed of that thrust is quite quick. And it's interesting that in this instance, whilst it took a long time to activate, it didn't really come to very much very quickly. And this one again failed. So you can see here the risk of using this method. It might over exaggerate things, but the different slopes are different time to activation are producing the different target slopes. The fourth one is another really quite interesting one, which is where we just say we don't actually know. We're just saying that we're going to track the price as we move towards the target. And so all of these previous targets are crossing through a price. What we've done here, we've got it in the settings. You can actually ignore the last 10 bars. So the reason you want to do that is you want to spot any divergence. So I've said the last 10. You could change it. So if we go and change the method to follow the price, now it's going to ignore these last 10 bars. So at the moment we're still tracking, but it just allows me to watch for any deterioration in the next 10 bars, next 10 days, because I'm always just looking back 10 days for where that target was met. If I use just this price and have no ignore factor in, as the price falls, these targets are all going to fall. So that ignoring those last 10 bars helps you to just spot any divergence from the track. The last one is the historic average. So the number of targets you've got configured, I normally have mine set to 5 because I don't really want to look at lots of targets, and they have got to all be calculated as well. And TradingView is using this Pine script. It's a bit slow. I'll talk about that in a minute. The more targets you're calculating, the longer you're going to get. But this method will basically tell you here these targets are now projected based on the previous averages. And so what's interesting here is that it's taking the last X targets. In this case, it found 10, the last 10 targets, and it's only targets that have been achieved. So these targets are being projected based on how the last 10 targets were achieved. And it gives you an average up and down. So it's kind of intelligent. And so here's 20 targets. You can see here it's projecting based on what the previous average are. These are still parallel because it's using the same average for these targets, but it's using the past ones, and you can see how they've all been met. That one was met, that one was met. Every time a target is met, that's adding to this calculation and averaging. That's what the average is. So it's another way of doing it. And so NVIDIA, we see here, I'm looking at the last 20 targets, on average, the up is 0.35% of a unit, and the down is 0.68 of a unit. So a third up and 2/3 down. So it just shows you that the counter trend targets can be aggressive. So it's just calculating, looking at where all these previous targets were met, and then that target is being projected based on the previous average. Now, this is where you might say, well, I don't want to look back too far because I want to take the more recent price behavior into account. And the more I average, the more I'm averaging over a longer and longer period. How far back can you go? So the interesting thing is, I mean, I've got here 50 targets. but we are limited with the scripting language in TradingView. It has processing limitations, so we can't go back a long way because it's just putting too much load on the system. So you may only be able to go back about up to 20 targets. You can set it to 50, but chances are you may not see 50 targets because we can only sample a certain number of data points without running into resource issues. So that's how it works. So increasing the accuracy of the targets. So time frame, support and resistance, and trend state are really important. Clusters. Remember I talked about clusters? So here you've got gold. This is a $10 chart of gold. These are all the targets that are on that $10 chart on the daily chart. There's the daily chart. And you can see here that all clustering to around this level. So somewhere between 3,600, 3,800, around 3,700. We've got 3 targets pointing in that direction. And we are also now able to cluster on time. So we can say, well, sometime around September time, that's potentially where we could be. This is like an ascending triangle pattern building. If we break, that's just saying that's what the potential is based on this price time of 2. Remembering it's approximate. It's not making a full prediction. Multiple targets are stronger. So this was the case we were just looking at IBM, 3 upside targets, 3 individual buying thrusts, 3 waves of buying across the last year have introduced 3 upside targets. So that increases the likelihood. In this instance, you've got upside targets, but you've got a more recent downside target. So that's just telling you that we may fall before we rise. And that's a really key point. And sometimes you see an unactivated target. And so we've got an upside target here. We've got an unactivated downside target. If that activates and turns red, that starts to make us wonder. And you can see how we're wandering away from the target. So this target is potentially exhausting. So you may have got very excited when you saw the target, but you do need to monitor how the price is performing relative to the target. And of course, these key levels are really quite key. If we break back above these levels, then we would look back to this target. So resolving conflicting targets. Here we see an example of where we're resolving conflicting targets. And there, at the moment, it is very much a sideways picture. This is a stock with 2 downside targets. It has been moving predominantly down. I could put the trend indicator on. Maybe this was just that target was exhausted and maybe it's not going to be reached. And if we break through these key levels, then we look to the downside target. So it's really important to use support and resistance with the targets. Here's another one. Always note the key levels. So we break below that level, then we look to this target. If we break above this level here, then we look to that target. So that's where the support and resistance are really quite key. And here's an example where you had downside targets, they were not met, and you've got 2 new upside targets. And again, if you break this resistance level, you start to feel that these are the new targets that are in train. So it does happen, frequently happens, that the targets are not being met. You take them as a guide. Here's an example of a target that's now less valid. It was given a long time ago. This was on the Dow Jones Industrial Average. Then we had a downside target. This target may now be done because we've got 2 new upside targets. And certainly, if we break to a new high, we will deactivate or negate that target. So at the moment, you'd probably say that one's too historic. This one is starting to look like it's done. And these are the 2 that we're now focused on. So when targets are no longer valid, well, I mean, you can see here it's an example of this target was given, almost met, and you'd start to say, well, that's an example of a target that was just probably done. And then you had downside targets kick in that were met. Downside targets being met is bearish confirmation, and then new upside targets. And if we break these levels, of course, if we break to new highs, then we really start to look at these targets. Note this target here is quite close to the previous level of resistance. So in fact, very close to that level of resistance. And that often happens. we focus on the nearest targets first. This target is the one we're really focusing on. We always like to say that I bet you a lot of money that this one will be met before that one. So here's an example of target Coca-Cola. This is a target that was given, not quite met. Then we had the lower high, and at this point the lower low, and a new downside target. You could look at that target and say it's done. And then here, starting to see it's not activated yet target to the downside, potential sort of head and shoulders pattern possibly building. Got a downside target there, but certainly toppy pattern. If we break that and negate it, then and notice that points back to that previous level. Now I have my levels configured to just show the last 2 or 3, but if you want to show more, you would have all these levels running through the chart. You can configure that. Beware of improbable targets. So this is one on the NASDAQ. We had a big move here, and it's predicting a very big upside target. Focus on this one first. You will find that on longer term charts, you get big upside targets. Here we're using a big box size log scale, and it dramatically exaggerates this chart, 5%, and then you're using 5% progressively bigger and bigger units, and it's a monthly chart, so it's a very long-term chart. So there's a lot that will happen before that could even happen. But so don't get too excited by long-term charts. Here's one on Bitcoin, projecting very big upside targets, but realistically, you might consider that one, but these ones are just too far. 2034, not many people are thinking about where Bitcoin will be in 2034. But that just shows you can use them on, this is a weekly chart, you can use them on very long-term charts. Not something you would normally do with a point and figure. You would normally use the day as the filter. You still use a box size of 5, but you won't get that projection into the future. One of the really big advantages is you can use them with other techniques. So, a point and figure chart is very hard to do that. So here, Bollinger Bands, John Bollinger has seen this presentation. I've given it in front of John, and he was impressed with it. New ways to move technical analysis into the modern age without abandoning the value created over the last 100 years. This is exactly what these targets are about. So it is worth pointing out that on TradingView you do get variation of data. So here, this is Saxo and ONDA. If you are on TradingView and you type XAU, let's type the code XAU, and you can see that you've got various providers, FXAM, ONDA, lots of different providers of gold. You will find their trade data varies, and so that is a factor when you're coming to look at the chart. So do bear in mind that you will have variations in the data. Right, this is probably a slide more for you just as a reference, but these are all the points in the settings. This is one big long dialogue. That's all we can do in TradingView, and this just refers back to the slides in the presentation that we've already looked at as to what these settings control. So you can look at that slide. The same on slide 2. So here we talked about the activation methods, and it just tells you what each of these settings looks to, the colors. Defaults, you can set your own defaults, which means when you get an update, if we provide an update, that you'll get an email saying that it's been updated. You can update it in TradingView. If you have your own defaults, they won't be overwritten. Otherwise, it will take the defaults that we set. Again, just visualizing, this is the setup. This is what all the elements of the setup that these dialogues control. So it just helps you to understand. There, as I mentioned, there'll be updates, and you'll get an email, and you can click the email, and it'll take you to TradingView script in the web page. You can then see this little thing, this little arrow. You click on that, you can get an update, and that will happen in the app as well. You need to restart the app. So the targets are appearing on more and more platforms. They started out on AppData, and on AppData we run on over 30 different vendors, so Bloomberg or LSEG, or lots of different ways you can use the targets there. On Bloomberg, they're now on the Bloomberg table. Apps Lingo is how you get to them, or you can now get them in TradingView, but you need if you want to get them in TradingView, you've got to apply for them first. In Updata, you can scan for targets. It's much more powerful, and we have done a lot of back testing of these. So anyone who wants to talk about back testing, we've done a lot of work on that. And what you'll find is that the money management tools of using optimized stops with the targets produces the best sort of equity curve. So that's another factor. So to take a trial, you go to www.updata.co.tv, just click on the page, and it will take you to that website. And this is where you just go try or buy, and you can apply for a trial, and we'll enable you. So that's really quite simple. There's the targets on TradingView. So why not give them a try and see for yourself? They're an extremely powerful aid. You can follow me on LinkedIn. I can't have any more connections. I've hit the maximum 30,000 connections, but you can follow me there. I'll do quite a lot of commentary, or you can always email ta@updata.co.uk if you'd like to take a trial. Let us know. But if you go onto this page, that's where you can get it. Hopefully, you'll enjoy using them. And anything you want to know further or want to ask, please just reach out. Bye for now.